Let me ask you a question. How many times have you seen a stock down 20, 30, or even 50% and thought this has to be the bottom only to watch it keep falling? That right there is what traders call catching a falling knife, and it's one of the fastest ways to blow up an account. In this episode, we're breaking down exactly how not to catch a falling knife, the traps that suck traders in, and what you should be looking for before you ever think about buying that dip. Welcome to Beyond the Trade, where the levels don't lie, the trades hit hard, and we're here to cut through the noise. No scripts, no safety nets, just raw market talk. Lock in. It's time to go Beyond the Trade.
Beyond the Trade is for educational entertainment purposes only. Nothing you hear should be taken as financial advice. Always do your own research and consult a qualified professional before making investment decisions.
My brother.
My friend, how are we doing?
We are doing very good. How are you?
I just can't wait to catch some falling knives here. Catch you on the phone, catch some falling knives. Let's just get right into it. I mean, why buying the dip keeps blowing traders up? I mean, right? We are in the generation of buying the dip. Wouldn't you agree, my friend?
I would. This last week or two there's been some interesting things going on with some stocks out there that. And I've had a few of them that I've looked at and thought, okay, this has got to be the bottom. And I pause, thankfully, and it keeps going.
And
I guess, which is really that definition, it's let the knife hit the floor, come to a complete stop before you reach down to pick it up.
Exactly. That's why we thought, let's talk about it. Because and it's been interesting to me to hear people, in my life just go, hey, well, I've got to buy this. I mean, my gosh, Microsoft is at $400, right? I've got to buy, right? It's just round numbers. There's no reasoning behind it. So we're going to get into how we define that, and we're going to talk about why you shouldn't be buying falling knives. So let's go.
Yeah, we're going to get into that. It's like we had, and some of the guys from the old group know that I love, when you get a big knife candle, I love getting in. But it comes with some experience and
essentially
it's a higher risk, but
Mike loves pain.
But I do those, and that's like on a 5-minute candle with a massive downside. I always live with the theory that the market hates that kind of a move that fast, and it comes back. And I've been pretty successful at it, but that's not really what we're talking about. On a falling knife, we're talking, not just a 5-minute candle. We're talking the daily, 3 days, 5 days of a stock falling. So don't confuse one big drop on a candle that was some data that came out that caused SPY to dump on a massive red candle, and then all of a sudden it's right back up and closing at all-time highs for the day. I mean,
Mike likes
that's
pain.
Not what we're talking about. It's helped my pain. I've made some money on those, but not on a real falling knife, ones that are days in the making.
And that's a fun place that we see ourselves in now, February 7th of 2026. I think I still write 2025 from time to time. I mean, we always, Actually, I think I've been better about it this year. But anyways, the falling knife trap. When something drops, I don't know, you can call it 20, 30%, no defined, falling knife, just like Mike was talking about. It may not necessarily, you could consider a one-day big drop a falling knife, and I agree. But when you see a bunch of, the S&P down, 2% in a day, I would consider that a falling knife. But, you see a lot of stocks that are down 20 to 30% from highs, and people think, okay, time to get in. It's fallen for a number of days. It's got to go up at some point, right? It's almost like the gambler's fallacy. It's, where it's, the roulette table has hit red 30 times in a row. Well, it's definitely going to hit black. It's got to hit black the next time, right? Or something. When in reality, it's a 50-50 shot every single day. That's not truly how this is, because there's a lot more going on behind the scenes. But your emotions, again, tell you, this has to be the bottom, right? And then sometimes, sometimes, oftentimes, price keeps falling and the losses accelerate, right? And I like the little quote at the bottom here: cheap can always get cheaper. And
Yeah.
I always tell myself, and you can think about this in terms of your account balance too, is things can always get worse. And so if you come into something, if you look at something and you just say, wow, this is down a lot. It could be.
It can't go any lower.
Right. It can't go any lower. I guarantee you, if you gave me a chance, I could make it go lower. Right.
I mean, a great example of that is and I guess more along the lines of what we're talking about. Look at a company like Enron. When that whole thing happened in the 2000s, it never stopped. It literally went to basically zero. We had crypto that crashed in 22 that wiped tons of people out. And it wasn't happening in one day. It was over many days. But, it's down 10%. I'm getting in. This is a good spot. Next thing you know, you're down another 80.
Well, you think about Luna. I don't know if you remember Terra and Luna and like UST. It was this crypto in 2022, 2023 that went down instantly, a lot, very fast, because they got hacked or something. Something went wrong. Anyway, I shorted it. I don't know. I mean, I just saw it going down and shorted it to zero. But people who bought that dip that said, oh well, this coin used to be $100, now it's 20. I might as well just throw some in just for fun. Well, you just donated people like me money. So I should be thanking you. Same thing. Crypto's a completely
it was in 22.
world.
I think it was 22 when Bitcoin had like a 70% drop in a month.
Yeah. Yes.
But that was day after day after day, and if you thought you were at the bottom, man, guess what? You weren't even close.
I mean, even outside of crypto, look at a stock like Oracle. I mean, my goodness, right? I mean, go here. I mean, Oracle was a $350 stock in September of 2025. 5 months later, it is 140. I mean, that is ridiculous. That's a crypto-sized drop. 60%. And it can still go lower, right? Things can
Ladies and
always
gentlemen, that is a good example of a falling knife.
So if you bought that, which, I kind of thought it was a decent buy up in this range a little bit, but the balance sheet is way out of control. They got sued. It was a whole bit. Anyways, so again, things can always get worse. Cheap can always get cheaper. And and this is a quote that I made up this week, and I'd like to share it.
Oh, God.
A bottom always has two cheeks.
Why did I know it was going to go there?
Did I say that to you?
No, but I can see you saying it. And I can picture where you were when you said it.
Where I was?
Yeah, just leave it at that.
Okay, all right. Yeah, so, and what I mean by that is, in a funny way, is that you always get things don't bottom and don't top in one singular day, one singular, movement. That you'll always get another opportunity. And you know what? Even if I don't, I can at least let the structure form. So that's why that's what we'll get more into, right? When people are getting destroyed, it's because there's no confirmation of a full-on trend change, right? People just buying price instead of buying the structure, like I just said. And if you don't have a defined risk in that trade, and your emotions are telling you that, wow, it's, down 50%, might as well just buy now. What could go wrong? Your emotions are fully in control, and people don't fully realize that buying these things just because of how far they're down is an emotional play. I'm not saying that right now, this past Friday was not a good buying opportunity, right? It's higher than it was on Thursday. Yeah, I agree with you. And I'm not saying that it's a bottom. I'm not saying that it's not. All I'm saying is, in general, just buying things because they're down a lot is not a good idea.
Yeah, and if you're trying to always catch the bottom, forget it. That's what'll get you started in your downward spiral, is going, oh, this has got to be the bottom, and you get in. It's, and we're going to get into this here in a minute, though, is looking for the signs of the falling knife possibly coming to an end. I mean, you got to put some things on your side to help with help your odds, basically.
Two cheeks.
Two cheeks. And every bottom.
At least two. What not to do? Writing that down. He is in Florida right now, so if you
I am.
yeah,
Beautiful
let me know if
day
you
here.
see. Let me know if you see anything out there.
I saw there's been a lot of two cheeks today, but
Okay, there you go.
I'm thinking that was the bottom.
Okay. What not to do? Perfect. That brings us to what not to do. Don't just buy because price is down, right? We've already kind of been over that. And then this one I think gets a lot of people. And I know it is so tempting. It is so tempting. Averaging into weakness. Mike, I want you to speak on this. You literally cannot control people when telling them that this is not a good idea, yet they still do it.
Yeah. I mean, and I'm sure this is coming up in here too, you have to look at what's going on around that. What's the volume look like? What levels were big levels in the past? How close are you to those? Or is there anything even remotely close? And if not, sit on your hands and wait. Don't worry about catching the bottom. Let it, we talk all the time about buy the dip. Well, a dip is different. It's only a dip when it starts coming back. So you're not buying it when it's still going down. You're buying the dip. It's dipped down and you start to see it curling. It's the same thing with the falling knife. Do not get in, and if the volume is high, that's not exhausted yet. There's a lot more people still selling at that point. Why in the world would you want to get in?
And exactly. I love it, and I fully agree with everything you just said. And it brings us to our last point. And also, whether you're a technical analyst and you use TradingView or not, if you see price just going straight down and you haven't seen any up days, you're buying into weakness, right? Doesn't matter what the volume is. You can just fully throw that out the window, throw technicals out the window. If you see it's been a straight line going down and it doesn't look like it's building any sort of trend, you're just buying because it's down, you're doing this. You're doing what not to do. And so the trend needs to at least form, you want to see higher lows. You want to see, at least a couple of bounces. And I do believe, theme / context is a really big thing too, because the market hates uncertainty. And when there's, uncertainty out there, and in this case, in the time period that we are in, there is a lot that is going on in the world, a lot, right? Whether it be geopolitical, whether it be certain files that the government is releasing, whether that has a lot of tech CEOs in it, or whether or our president, there's a lot of things that are concerning right now. And not to mention new Fed chair. We don't know how the market seemed to react to that, but there's also a lot of different things going on. So when you have context to this picture, it's like, okay, it makes sense because markets hate uncertainty.
We've got a good example coming up later that's basically a potential banger for towards the end here, and it's so true. If you got to start looking for higher lows, and probably even more importantly is wait for some declining volume. Declining volume is giving you the idea that there's selling exhaustion. Okay, the sellers are starting to slow down. They're out. They're getting out. And that's usually when you can start looking for the reversal, in my opinion.
Yep. Yeah. Yes. Agreed. Breaking key support levels on high volume is not a good sign. Just FYI, for those that haven't read the book, that's bad. And sometimes, but also I would be careful with low volume upwards moves. Often are those dead cat bounces where it's just shorts covering and sucker rally buyers, but they can be very powerful. So you can see very big movements with low volume. So
I would add for option buyers that if you're playing options, this is the time when you want to add time. You want to go further out. If you don't want to buy a stock like that's in just ending a falling knife and buy weeklies. You should be buying 2 months out, 3 months out, and give yourself time because it needs time to settle. It may sit down there at that level for 2-3 weeks, and you have some ups and down days. If you're going to get in when you start seeing it, like you feel like the sellers are done, it could sit there for a long time. It's not necessarily going right back to where it came from. So buy yourself time if you're getting in, and get in smaller size to start. And give it a couple of weeks if you have to before, and then if you're going to add more, but add them 2 months out, month out at least, I would say. But of course, every stock is different. Everything you see is different. What other indicators are giving you ideas and that? But I would definitely not play weeklies trying to catch a falling knife on its way back up.
Yeah, they will literally go to zero, and weeklies will literally go to zero instantly if you're wrong, and instantly. We pretty much covered all these already. But yeah, what the smart traders wait for is selling pressure to slow down or exhaust. Right? You want to see some buying pressure, like a base or consolidation at least. Consolidation does not necessarily mean it's going to go up, but it's at least some structure for you to potentially build upon, right? And then ideally, after you build some consolidation or a base, having a high or low, reclaiming as a past level that was a resistance, reclaiming that, and now that being support, right? So, which I could show you just a really really brief example here,
and use your indicators too. But you go out to the daily, the weekly, and look at the RSI. Look at the MACD. Look at some of these things that are going to give you an indication of, is it really exhausted? Did it really hit the bottom? And RSI is a great one for that.
Here's an example on Microsoft. Where, like Microsoft, we talked about this being a base, like in a potential bottom, right? And because I liked this 465 level and it base. But here's the thing: it never reclaimed 495. I thought it would. It never did. Never reclaimed it. That if the bull case was going to happen, it would have consolidated, built that base, went up, then probably came back and retested 495. That went, then went up. It could never break over 495 and then hold it. That's why I always like to say. And here's an opposite example, right? NXT, one that I literally harped on for I don't even know how long. It was at least months. Down in here. So same exact setup as Microsoft in a way, right? It could have broken. It could have just kept rejecting and then broken down below 80. But it ended up breaking out over 95, which was the consolidation high. It came back down and retested it, which I even put on Twitter and said as soon as it touches 95 again after breaking out, I would probably buy that. And then boom, and then it hit 130 like 2 weeks ago. So, and now it's set 120. So that's what I mean by let a base form. Don't just watch your high or low, because usually you can just buy at the top of that old consolidation range. I know that's pretty technical,
right?
But so then you get to how institutions actually buy. They wait for the weak hands to finish selling, right? And then they buy after the structure forms, and then they define their risk before they size. So what that would mean in this case, right, is for example, if I thought the bottom of this consolidation range was $83 on NXT, if it closed the day below 83, that would be my risk. If I went to Oracle and I liked buying Oracle at $200, and then I called my last line of defense 185. I would sell on any day that broke below 185, right? You have to establish if you're going to buy something that's down a lot and you're not sure if it's the bottom yet, you need to at least have a defined risk. That's for any trade.
And your
you won't
risk
survive.
management needs to change. Yep, you need to change your risk management when it comes to falling knives too. Tighten up your stops, limp in. Don't go all in right out of the box. Have trailing stops, whatever works for you, but also have exit rules that, okay, if it gets to this point, I'm out, and because it maybe is not the bottom, it's not what you thought it was. But you definitely need to tighten up your risk management when it comes to falling knives. They'll kill you. They will literally blow up accounts.
I mean, you should be buying as close as humanly possible to where you think your stop would be, right? Does that make sense, Mike?
Yeah.
Like as close as humanly possible, like that NXT chart or Microsoft. If my last line of defense was 465, I would want to buy as close as humanly possible to 465.
Right.
Because that gives me more upside and way less downside. So if it's an established level, which is why a proper dip buy checklist has many things, right? First of all, you at least want to have some sort of trend alignment, meaning, you've had at least some support built, or a confirmed reversal is even better, where, in the case of NXT, which I just talked about, a breakout, retest, going up, got to have your defined risk. If you don't have defined risk, then your trade is based on hope. And
you have to look, regardless of what stock it is. I mean, I guess like SPY is a little different, but any one particular stock you're in, it's also important to look at that sector, because just because you're watching one stock that is literally in the middle of a falling knife, what's the rest of it doing? Is it a change? Is it a bear market all of a sudden? In that case, let it keep going. Don't get in. Don't try to change a bear market. You're never going to change it, But we get caught in this. We've been in such a bull market for so long, everything is just a dip. And that's not necessarily the case. At some point, it will become a bear market again. And you don't want to I'm watching this one stock, and I think it's there, and it's hit this level. I'm going to get in. And everything else around it is continuously going down, and they're all down 10, 20, 30%. The market has changed, guys. Not the time to start. You're not going to make a reversal happen, period.
Yeah, I would also warn folks, to your point, Mike, that if your stock is down 2-3% in a day and the S&P is flat, I probably would not buy that, because eventually the market is going to go down.
Yeah.
And when it goes down,
you got to look around you. What's going on around that particular stock, and what's going on in the market? I mean, it's such a mind-boggling game that we play every day, and there's so much to know that all these little bits and pieces that we give you, and in this podcast, you put them all together, and my God, it's very overwhelming. It really is. But it becomes 100%. Second nature the longer you do it.
And that's why you are the best of the best, Mike.
Me.
There's literally no one. There's literally no one to do it just quite like you.
Well, I'll just add to that. If I was the best of the best, I wouldn't be sitting in Central Florida. I'd probably be on an island in Bali or something.
Wow. Okay, now I know your deepest, darkest secret. I mean,
I do my best. I've learned a lot, and I learned a lot from you. I learned a lot even doing these podcasts. I still learn. It never stops.
I think, and here's, okay, and this is a part of why these are great final takeaways. Thank you, Mike. And yes, honestly, I learn talking to you every day too. And the more we do this, the more we learn. The market's not going anywhere, right? It may evolve over time, and it will. And trust me, everybody's 401k's in it. I want to be knowledgeable about that area of my life, right, for the rest of my life, because I know it's always going to be important. So,
yep.
But,
yep.
Final takeaways, 3 of them. Catching falling knives feels smart until it isn't. Let that sink into your brain. Let that sink in. Right? Just because something's down 20, 30, 50, 90% does not mean it's a buy. Right? Does not mean it's bottomed. And honestly, the further the fall, which you've seen a lot of these things fall very far, the longer it may take to actually form a bottom. Granted, there are some total outliers like the tariff situation, COVID, but you go back and you look at 2023, October of 2022, right? That whole time period where it actually was, a bear market, it took a while and there was a lot of faking out. So that's why I say patience is a position. Number 2, patience
Don't let
is
FOMO kill you, man.
Yep. Patience
You can
is a
always give
position.
in. Yep.
And this is where I say, Mike, to your point about learning about just doing these podcasts and just paying attention is, dude, sometimes I feel like the most I learn is when I'm not actively trading.
Yeah, true. I've had those times too. I'll step away all week, come back, and you just have fresher eyes. I don't know.
Paying attention but not actively trading, I think because, and honestly, I feel like, buying things that you have high conviction in, but not, and just trying to be an observer. Being an observer is so powerful. It's very powerful, but the market will always give another entry. Number 3, the market will always give another entry. Like I said, even if you missed NXT at 90, you can buy at 95 when it retests. When it breaks out to 110, don't chase that. Do not chase. Comes back down. Almost always can. A bottom always has at least 2 cheeks, right? Here's the thing, even with tariffs, there was 3 different days to buy at those levels, 3 or 4, right? So you had a number of days. I mean, it's COVID too. I mean, even the most aggressive bottoms give you at least 2 or 3 opportunities. So anyways, that's my takeaway. Catching falling knives feels smart until it isn't. Patience is a position, and the market will always give another entry.
Yep, 100%. It's, again, stay away from FOMO, and it's so easy to look at some of these charts and go, oh, man, look at this. This is what a great setup. It's at this level it's bounced off of 10 times before in the last year, but it's down 30% leading into that. Well, guess what? That level is probably not as strong as it once was. Which
I think
brings
it's
me
time.
to, I think it is time. What's it
It's
time
time. It's time for All right, Mike, what do you got?
Oh, I'm going to simplify this and make them a little smaller instead of giving all these out every week because the market's in a little bit of turmoil, in my opinion. But the one that I'm watching is Hood. Hood was way up there, like 153, 155, somewhere in that range. And it was down at 72 the other day. It's had a rough month or two, and it did have a good Friday. So this is the perfect example of the falling knife.
Yeesh.
I had a level at 105.50, 106.50, and it seemed to be a pretty solid level. Well, boom, it blew through that. Next level was the big number, 100. Okay, well, it's going to have to stop at 100. Nope. It went from 100 all the way down to $70, basically. There's the perfect example of a falling knife and getting in way too soon. That thing never reversed. It did not have a green day. 2, 3, 4, 5, like in 15 days.
You literally were down 30. If you bought at 100 thinking that you were buying a psych level, right? You were literally down 32% in 5 days.
Yeah.
on a $75 billion company.
Mm-hmm.
Wee woo.
But I like the indication of Friday. It had a big jump. It opened up Friday with a pretty good day, but the risk here is they have earnings on Tuesday. So what I would say is this is my Sunday banger. I think Hood is going to recover this relatively quickly, but let's see what happens on Tuesday for earnings. If you're a gambler, gamble, but I would not advise it. Friday was a good day, but man, if they miss on Tuesday, this thing, you could be back to 50.
Yeah, I could. Yes, 50s.
One I would definitely limp into.
50s for sure.
Yeah,
Yeah. Agreed.
that's my banger.
Okay.
What
volatile.
you got?
Everything's volatile. This brings me to the stock of a lifetime, the stock of a century, the stock of a generation, the stock that wins because it limped in. Apple.
I thought you were going to go core weave.
All right, everybody take a shot. Everybody take a shot. Core weave was mentioned.
I'm just
Apple.
busting your balls, buddy.
Apple. Okay, here's why, everybody. Here is why. Apple, we've talked about this. Oh my gosh. Remember when we talked about it at 200? I don't know if we definitely did. Oh, that was just such a good entry there on that wedge. But Apple, late to the AI party, right? They didn't put out all this CapEx. They didn't spend on data centers, all of this stuff. I mean, yes, they have spent on AI, but they kept delaying Apple Intelligence here, Apple Intelligence there, and then they just paired up with Google. Great. Who's the best one? And then, little did they know their Mac Minis would turn into a gold mine. So now, with the last week's release of Claude, not to be confused with Claude, the Anthropic tool, CLAWD bot. And since it got so big that Claude, like Anthropic, made them change the name. So now it's called OpenClaw. Okay? And this is basically an autonomous AI agent that it's open sourced. You install it, you give it shell access on your Mac or on anything, on any machine, and it just can do things for you. And there's so many tools already built on it. You can have it call you. I mean, it is ridiculous, the things.
I know nothing about this. You need to teach me.
Shh, do not tell
You need to
anybody.
teach me.
Well, they've already talked about it on All In podcast, so it's over now. Just wanted to let
They
you know.
missed out on a naming opportunity, in my opinion.
Well, really?
Yeah, why not just call it iCloud?
Then Apple would be coming after you.
But it is Apple.
No. This is an open source software. But here's the thing that this is not an Apple product, Mike. This is
okay.
This
I
is
missed
a
that part.
so yeah. Sorry. Okay.
They're utilizing.
Let me back up. People are buying Mac Minis hands over fist because this software is not necessarily safe. Because you give it shell access, meaning it has access to everything on your machine. So people, including myself, wink, wink, are buying Mac Minis in order to then give it dummy accounts for, like, create dummy accounts for whatever, Outlook, Google, whatever, and then just let it run wild on that machine with no security possible issues, right? That is why people are just buying Mac Minis, and then they're installing Claude on there, and then they're using them as individual AI agents. Go listen on All In podcast. And one of the guys said he has a team that's installed 6 of them now. They do that. They download CloudBot. They run it on Kimi, which is a cheaper API than Anthropic or OpenAI. And they just have, like, they train them to have these agents to have individual tasks that they do and are working on 24/7. Is like, and they have access to the entire machine. And that's why Apple is going to continue to go up, in my opinion, because I think Apple hit a home run, knowingly or unknowingly, with being a key infrastructure piece to potentially the new agentic AI bull run, which is very exciting. I'm about to go, after we close this down, continue setting mine up. And I think, Apple is really well positioned, and they're not getting beat up because of because of CapEx spend, because they don't have much, if any. So
interesting. I have 2 Mac Minis. We need to talk after this podcast.
Well,
or maybe that's another whole nother episode. Who knows?
Whole nother episode, I would say. Let me get mine set up first, then we'll get into it. Clickbait. Well, everybody, thank you so much for tuning in. I hope you just have a wonderful week, and we'll be right back at it next week. Thank you for joining me, Mike.
Subscribe, comment. It's good to be back. Missed it last week. Enjoy it. Let us know what you think.
Yep. Smash that like, subscribe, and take it easy. Adios.
Later.